Alright, so in this video I want to talk about rebalancing. This is probably another really difficult thing to do. When do you rebalance? How do you rebalance? And I'm going to go through everything basically today. So while you're saving when you're young, basically you are rebalancing your account every month if you're dollar cost averaging every month. The sooner your money's in the market, the better. The best time to invest was yesterday. So if you're thinking about investing, just put that money in the account. The lump sum dollar cost average argument really should only come up a few times in your life. Maybe when you get a large commission check, like a bonus at work, maybe when you sell your home and downsize, or maybe when you get an inheritance. At that point, yes, you should still lump sum, but dollar cost averaging is just a little easier and gives many investors a little more peace of mind. So the most important thing about rebalancing is having a target for your money. Basically, this picture on the left, I get it's a little bit fuzzy here, but this is the behind the scenes of Edward Jones. This is basically how they're building every risk tolerance, the exact percentages. They're hitting these targets for their clients. Why? Because this is how it works. This is safer. This is better. There's less volatility. There's just less potential outcomes and you have a more comfortable retirement. So this is the template that their CFAs came up with. Here's all the tickers and the exact percentages. So the most difficult thing about all these Canadian templates, every financial institution is doing the same thing. When do you lower the client's risk tolerance? Maybe someone is willing to accept risks, but their retirement, says they don't need it. Why risk your money 100% stocks to potentially ruin your retirement when a 60-40 makes you comfortable the entire way through? Just keep it simple, stupid. Don't shoot for the moon and potentially ruin your retirement. This is why people lower the risk tolerance to more like a balanced, you're green in the middle. This is like maybe just at retirement or before retirement. And your blue, this would be like a lower risk tolerance. Like these are very conservative portfolios and they're going to have a lot of bonds. This is their income. So Edward Jones has it labeled aggressive, growth, growth and income, aggressive income, income. These are how they're categorizing the investments, and they each have an asset class. Emerging markets is emerging markets. Canadian is Canadian. US is US. So anyways, why do you want to rebalance? It's just to make your money safer. When things grow too quickly, probably sell them. You probably want to shave a bit of that position off, and that's what InvestCan and InvestUSA help you with. So I just want to go through like a younger person example quickly here. Let's say you're 25, you're retiring at 65, and you think you're going to live till 95. So you use the app once with your first 25 grand. It said, hey, you should have been 100% equities, and you're about to use the rebalancer and put new money in. So let's just say a month has passed and they're going to rebalance their account, but they're actually going to contribute another $1,000. But I'm going to break this into two steps to kind of show you exactly what's going on here. So let's just say they're going through their investment portfolio and now they have $4,500 in FRDM. They have $3,000 in IHDG. They have $8,000 in VGT, $4,500 in XMMO, and $5,000 currently in QQM. So let's just click Invest USA and see what happens here. Some things have gone up and some things have gone down. And what it's saying here is, hey, if you're not investing any new money, tech grew a little bit too much too quick, maybe shave $500 of that off and buy a little bit more mid-cap, put $300 in there and a little bit more emerging markets. Or just buy one, just buy XMMO. Now, let's say they're putting in that $1,000 and let's see what InvestCan's going to do. Maybe you should still put most of that money in XMMO and FRDM, but putting $500 in FRDM and XMMO, that's not going to be the end of the world. Why I say that? When you click into the rebalancer, you're 95% on target. There's nothing too bad at all. And basically what I did here is when you touch the graph, it will say, hey, how many percent am I off? So you're within 5% of the target, your money is fine. There's no reason to panic and rebalance your account any further than this. Alright, so in this example, I want to show you basically a retired individual. It's a great idea to rebalance your account twice a year, and at this point, this is when you're going to withdraw from your account. So basically, I want to show you here a $1 million client, and there was just like a lot of volatility here, and basically, they still have $1 million, but now there's $100,000 in each asset class. What does this person do with their monies? So this person, the current recommendation is a 60-40 portfolio. So now if you click into this portfolio button on the left here, it's going to show you, hey, this is how your current portfolio is invested. Hey, you're a 50-50 split. You're 50% equities and 50% fixed income. But really, the risk tolerance is saying, hey, you can be 60-40. So what the app's going to do is say, hey, this is your to-do list, your rebalance on the right-hand side here. You should be 11% FRDM, so you should buy 12,000 of that. Maybe sell 26,000 of your international fund. Buy some tech because you didn't buy enough the first time around. Buy a little more NASDAQ. So when you look at this here, you should probably definitely rebalance your account if anything is over 5% overweight or underweight. So you can see here, you should definitely get rid of some of your cash, definitely get rid of some of your tips. So again, the main thing about rebalancing is having an initial target, basically having kind of the recipe for your investments so you have something to rebalance to. How can you rebalance if you don't have a target? You're just throwing your money in the wind.